Good morning and welcome to this Wednesday, February 12th edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we had another pretty good day in the market yesterday, although we did finish well off the earlier highs. We saw the Dow Jones having a pretty decent day, moving up near that 29,500 level before finally turning back. You can see here on the chart, we got up there. Looked like on an intraday basis, we did set a new high, but we were unable to close up there. So the Dow did pull back. You can see finishing relatively flat on the day. The S&P 500 finished up another 5 points. We did set another all-time high record close, 3357.75. The NASDAQ finished up 10 points, but again, that was well off the earlier high. We were up close to the 97.50 level before coming all the way back down, close at 96.38. So even though we finished with some modest gains across most of the indices, it didn't feel nearly as good because we did give away a lot of those gains later in the day. Still, the overall uptrend, in my opinion, remains in play. I see the indices going higher. We are in the time of the calendar month where we do typically begin to see the market move higher in anticipation for mid-month money flows coming in. So it is the 12th of February. The 11th to the 18th tends to be a pretty decent period. Not as strong as the 26th to the 6th, 26th of one calendar month to the 6th of the next. So it's the 11th to the 18th isn't as strong as that period, but it is a strong period historically. So we'll see whether or not that continues to light a fire under U.S. equities. Looking at the various sectors, you can see down here we've got real estate moving higher, breaking out yesterday, and then breaking out the day before yesterday, and then adding to it yesterday. Energy got a little bit of a bounce yesterday. Crude oil prices back over $50 a barrel, and so we did get a little bit of a pop there. Discretionary also did well. Amazon very strong earlier in the day, and it continued. Even though it pulled back, it still had a nice gain for the day. That has been one of the drivers in the discretionary area. Also, home builders, with the 10-year Treasury yield still down low, home builders have been very strong of late as well. Staples, not so good yesterday. We did have a reversing candle. We had broken out earlier in the week, but we did reverse yesterday with that reversing candle. We'll see whether or not we can move higher off of that, but Staples, the worst performing sector. Technology actually took a break. I haven't seen this very often, but technology was down yesterday about 1/3 of 1%. All right, 10-year Treasury yield. There really no key economic reports out today. Jerome Powell will be speaking again. He spoke yesterday. I don't know. I'm not sure if it had anything to do with his speech, but about the time he started talking, got into the details, it seemed like that's when the market topped and started falling. And of course, the Fed actions or inactions in 2019 marked almost every single top. I was a little disappointed. I'm sure the bond market was a little disappointed that the Fed chairman didn't speak more about disinflation. Most of his talk seemed to be centered around the fact that they were monitoring growth prospects based on a number of factors, including the coronavirus. I think the bond market would like for the Fed to recognize a little bit more what's going on in terms of inflation or disinflation. But that was not the case yesterday. Anyway, he will be speaking again today. Maybe he will bring up a little bit more about inflation. We'll see. 10-year Treasury yield. Let's get a quick update on this. We are up today. You can see right here, we're up about 3 basis points, 1.62%. This is going to be an interesting test up in here around the mid to upper 160s because we had the previous high get up to about 167. And you can see this prior low over here and this low, both in the upper 160s. Then throw in the 20-day moving average, which is 1.65. All of that short term could put a lid on the 10-year Treasury yield. Normally, the 10-year Treasury yield topping and possibly rolling over would have me a little bit more nervous about equities. But again, everything I'm seeing, all the different intermarket relationships I look at, are suggesting to me that the 10-year Treasury yield is moving lower based on disinflationary fears. I wouldn't say deflationary, but disinflationary, that we're not going to be able to achieve the Fed's target. Therefore, the Fed needs to cut rates. Stock market loves it. Normally, the stock market does not like the 10-year Treasury yield falling. Ordinarily, that would be an indication of economic weakness ahead. But I don't think that's what the bond market, I don't think that's the message of the bond market, what they've been sending to investors and to the Fed. I think that the bond market would like another rate cut, to be honest, to try to weaken the dollar and inflate commodities. But at least for now, we are seeing the 10-year Treasury yield move up. So typically what we've been seeing is when the market moves down, or when the 10-year Treasury yield moves down, the bond or the stock market tends to move up or at least consolidate. Doesn't really take any big hits to the downside. But when the yield goes up, that's when we tend to see a pretty strong rally in U.S. equities. So let's watch this today. This is a good sign. We're up a few basis points. If we could break back into the 170s, I think that would be really bullish. I'm just not sure that the bond market, I don't know why the bond market would reverse at that point and sell off to the extent that we would see that kind of movement to the upside. But just throwing it out there, if the 10-year Treasury yield were to move above 170, I think that would add even a bigger fire, light a bigger fire under U.S. equities. Okay, let's keep moving on here. I did want to mention, I talked earlier about the fact that home builders, this is a 1-week relative strength chart of industry groups relative to the S&P 500. Coal right now is the #1. In the last week, coal has actually outperformed the S&P. But if you pull up a 3-year relative chart, here's coal relative to the S&P. So we get these bounces once in a while. They really generally don't amount to much. And you can see on an absolute basis, the coal index has been dropping like a rock for the last year and a half. More than that, maybe about 20, 21 months. So this is not a great group. So even though we are seeing relative strength here for the last week, that's not a group that I would be interested in. Home builders, however, when you pull this up, on a relative basis, we just broke out again. And so we've got a really nice trend moving higher. If you want to outperform the S&P 500, well, home construction stocks are one area to do just that. You can see on an absolute basis, we're breaking out. So you can take two different ratio charts, or, you know, when you look at this, you can look and say, well, coal's outperforming, home builders are outperforming. But when you pull up the two charts, I think they are anything but the same. They, to me, are like polar opposites. I would not even be touching coal. And in fact, coal, after this move this past week, probably is done based on its history, whereas home builders may just be getting started. Also on this list, I wanted to point out the biotechs. And I've been talking a lot about biotechs. They did close above 2,200 yesterday, and it was only, I think, the 4th or 5th time in history that the biotechs have been through 2,200. When we look at it on a relative basis, it seems like we bottomed last summer, and we've been putting in higher lows and kind of just stabilizing at this point. And you might say, well, you know, we're not really seeing any great relative strength. Well, it's true, but we haven't seen a breakout either until yesterday. So here we broke out above that 2,200 level. The only other time in history that we've been above 2,200 was that very quick move up in January of 2018. Literally, we just exploded to the upside. And then like 3 days later, we were back down below the 2,200 level. We came right back down. So this one, we're going to want to see whether or not we get this confirmation. I think this is the real deal. We'll see. I can, you know, guess, but it'd be better to see it. So a couple things I'd be looking for here. Number one, obviously, on an absolute basis, we want to see it continue to go higher. A move back and close back below 2,200 for a couple of days, 2-3 days in a row. That wouldn't, you know, I'd probably back off and maybe consider it more neutral. But if it stays above this 2,200, and especially if it starts to add and tack on gains and gets above that January 2018 high, and we begin to see improving relative strength like we have over the last couple of weeks, that would be a pretty good sign. Ultimately, like I said, I'd like to clear this 2275 area. And then also, I'd like to see the biotech index relative to the S&P clear that November relative high. That would really start to get me bullish the group. I'm already bullish. I like the breakout above 2,200, but I think that would really begin to add some fuel to the fire if we were to get a breakout there. Watch that relative PPO. We're almost right on the zero line, but if that continues to move up, we will begin to see some pretty significant relative strength, I believe, in the biotechs. We have not been above we certainly haven't been above 1 on the relative PPO since all the way back at the end of 2017. So we're talking about 2 years, 3 months. That's a long time to not really have any significant relative strength. So biotechs start to turn higher. This is a group you definitely want to be paying attention to. We all do. One other thing I wanted to mention, I've gotten some emails recently talking about gold and the fact that, and let me go back over here for a second. Let's just pull up the chart of gold. Because the questions coming in is, why don't I spend more time talking about gold? We had a nice breakout back in the summer, consolidated, and recently just broke out again. And so isn't gold an area to be thinking about or considering? And my answer is no, I don't like gold. Yes, it's going up. It's in an uptrend, so I'm fine with that. But when you look at gold, there's generally a couple of times where you really don't want to be thinking about gold. Number one, when the dollar is in an uptrend. So since we bottomed in 2011, we have been, and I could annotate this, since we have been moving higher in the dollar, you can see that uptrend in play. The last 8-9 years, while this uptrend's been in play, look at gold relative to the S&P 500. Now, my goal is to outperform the S&P 500. So as long as we've got an uptrend in the dollar, and I've been saying short term, I could see the dollar pull back a little bit, but I don't know that that's going to create any kind of major rally in gold. We might see gold move up a little bit, but I think the stock market is stronger. And this is what this relative strength tells me. So gold, despite the fact that it's been going higher, as you can see right here, when you look at it on a relative basis, it really isn't doing anything. If anything, since about August of last year, it's been coming down on a relative basis. So yes, gold's going up, but the S&P is going up faster. So any money you're putting into gold, in my opinion, is just hurting your returns. So I mentioned there's two things that when gold tends to struggle. Number one is when the dollar rises. The other problem is, and you can see here, see how the gold versus S&P back in the 90s was dropping, and yet the dollar wasn't going up. It wasn't the dollar that was creating the drop in gold. It was the stock market. Gold, you have an alternative to gold, equities, different asset class. When the U.S. stock market is rolling, gold generally underperforms. It's a hedge, more of a hedge than anything else. I mean, if you want to diversify, you can certainly do that. But I believe that diversification into gold in a strong market, and especially when we got a strong dollar, is just throwing money away. That's just my opinion. Those who like to have it as a cushion to make you sleep better at night, I totally get that. That's fine. I tend to be a little bit more aggressive. And so when I've got my money at work, as long as that dollar remains in an uptrend, I'm not really going to be that interested in gold. When we go back and look at the first 10 years of this century, 2000 to 2010, we had a couple things working for us. Number one, the dollar was weak. And number two, we had two nasty bear markets in U.S. equities. So gold is going to be in favor because it had two things going for it. Right now, it has neither. And so that's why I think we've been in this downtrend and why personally I would continue to avoid gold. All right, let's move on to earnings reports. First report, Lyft. Lyft came out, they did beat on their top line. They had 1.02 billion in revenues versus 980 million, 0.98 billion. So they had a nice beat on the revenues. Bottom line came in loss of 41 cents versus an expected loss of 57 cents. They guided quarter one revenues higher. Everything seems pretty good. Stock is down 4.6% in pre-market. Probably going to come back down close to this, or might work its way back down close to this breakout level, maybe around the 50-51 area. I actually think if you were going to look into Lyft, that would probably be the area that I would look at it. It did break out recently here with increasing volume, taking out these highs around 50 bucks. You've got the rising 20-day moving average now at 48.77. So any kind of a pullback to the low 50s, I think, begins to improve the reward to risk here, if you believe that this is the start of an uptrend. Uber certainly has been rolling nicely. So Lyft moving up in sympathy. Of the two, I think I like the chart on Uber better, but Lyft has certainly been improving. And the report didn't seem that bad to me, but it might just be, buy on rumor. Stock ran from $47, $46, $7 up to 54 before the report came out. So we might just be getting $2 or $3 pullback here because of that. If we get an open and then a real nice hollow candle behind it, I think that would be further indication that we do have an uptrend in play. Akamai, nice report here. Akamai beat on the top line easily, 772 million versus 749 million. Bottom line, $1.23 versus $1.13. The stock is up 4.5% in pre-market. They did guide fiscal year 20 earnings per share higher, and it's part of that internet space. It's been very strong. So Akamai, which seems to have kind of broken that relative downtrend back in the middle of December, it started to turn back higher. Looks to get a little bit more of a lift in terms of relative strength and absolute strength today as well. So nice report out of Akamai. Be watching this one. Let's see, another report out. CVS reported this morning. Nice report here. Easy beat on the top line. Bottom line, $1.73 versus $1.68. Stock up 2.75% pre-market. So that's going to be a couple of bucks maybe. And that will take it very close to this breakout level. So I always like to see if it can clear the key candle body, the highest candle body on the chart, which to me is 76.25. So if we get an open above 76.25, that would be a little bit more bullish to me. That's what I would watch for today. Let's see. Probably I'm going to give the best earnings report of between last night and this morning. I'm going to give the best earnings report to Shopify. That was a blowout report. Easy beat on the top line, 505 million versus 482 million. Bottom line, 43 cents versus 23 cents. This is what the market loves. These earnings numbers that are growing rapidly and create even more future earnings growth as we look out, and then you discount those earnings back at an incredibly low interest rate. The value of these companies skyrocket. Shopify today up 8.5% in pre-market. So that's going to be, let's see, 10% would be almost 50 bucks. So it's probably about 40 bucks. Looking to open maybe 530, 535, something like that. Another breakout. Don't know what to say. I mean, software is strong. Shopify, one of the strongest stocks in the group. So it's one of those stocks that absolutely you want to either own and hold or certainly be considering trading on any pullback. One company that was a little disappointing, well, was a lot disappointing, was CyberArk. So CYBR, they beat on the top line, beat on the bottom line, and it was a nice report, 97 cents versus 80 cents. But they guided quarter one revenues and earnings per share lower. They did raise their fiscal year 20 revenues, but they guided their fiscal year 20 earnings per share lower. So 3 out of the 4 in terms of guiding future revenues and earnings per share, 3 of them they guided lower. Stock's down 8.5% pre-market. And when you look at it, you can kind of see why it has not really been performing well relative to the software group. So it came out with pretty good numbers, but the guidance not very strong as opposed to Shopify where they're raising guidance. Another really bad report. This one came out last night. Insperity, NSP. I always talk about never just one cockroach in the kitchen. It's that old Wall Street adage. You can see here the big drop. You can see here the big drop. We're down 20% in pre-market. So we got another one today. So yeah, it looked good here for a few months, and somebody looking at a short-term chart might have been excited by that. But when I look at these huge drops, like this, it always makes me nervous we're going to get another one, especially when you go into an earnings report, because that would be the catalyst potentially for a big drop. They beat on their top and bottom lines, so there's the good news. Bad news is they guided Q1 and fiscal year 20 revenues, or excuse me, earnings per share lower. So it's the opposite of Shopify. You know, you want to have strong earnings growth in a market like this. You'll be handsomely rewarded if you do. But when you're going the other direction, there's just nobody wants to be in this environment. You'd rather be in bonds, which are still gaining ground, than be in a stock like NSP. So looks like the stock's going to have another big gap down today, probably above. It would have to go down probably close to 30%, 28, 30% to drop below the prior low. So the fact it's down 20, maybe it holds this low, but that's not my style to try and find a bottom like that. Western Union, also a little disappointment this morning, down 5% in pre-market. They missed on their top and bottom lines. When you look across here, we had been seeing some weakness in relative strength, but as of November, this was a stock that was performing extremely well. The good news is they did guide their fiscal year 20 earnings per share higher. My problem is you just missed earnings. So should I believe the fact that you're going to beat? And that's what I think Wall Street faces. You know, do you want to trust a management team just came up short of estimates and go along with their projections, or do you want to wait and see it? We'll see what happens with Western Union today, but it does look like the stock will be down about $1.40, $1.50 at the open. All right, let's see what else do we have. Well, Moody's. Moody's has been a really strong performer. You can see the huge move up off that October low. Been moving up very nicely, breaking out to a new 52-week high. This is a stock that I would have expected a pretty good report. They did beat on their top line. They beat on their bottom line, $2 versus $1.92. They guided their fiscal year 20 earnings per share slightly higher. Stock is flat. I was seeing up a fraction of a percent, 0.06%. So, but it's also run up a lot. So it's got a lot of it already built into its stock price. But this is one I would definitely keep on my radar. Beating and then also showing relative strength like this. This is the type of stock that I would be very interested in. Also, looking at their group, specialty finance, you can see the breakout in terms of relative strength versus the S&P 500. So you got a strong stock and a strong group. This is definitely a company that I would keep on my radar. Let's see, maybe one more. How about laser or lattice semiconductor? I'm sorry, LSCC. This was a semiconductor, and a semiconductor that looked like it was really beginning to pick up again, starting to break out and extend that prior rally after it had consolidated for several months. But then it kind of pulled back, and I think I was talking about this one earlier this week. With that heavy volume pullback, normally a pullback with light volume, I wouldn't be so concerned, but this heavy volume pullback had me wondering what the heck was going on here. You can see that Lattice relative to the semiconductor group had moved to about a 6-7 month relative low. So there were some things to worry about there. They did beat on their top line, although it was barely 100.2 million in revenue versus a 100.1. Bottom line, 17 cents versus 15 cents. So they did beat. I believe they guided in line, and the stock is up just under 2% pre-market. So it looks like it's going to gap back up above its moving averages. Let's see whether or not it holds it. This is one that I really don't know which way it's going to go after it opens. I'd be certainly careful and watch the action today. All right, let's move on to upgrades and downgrades. Just a couple here. Cardinal Health upgraded today. I like this upgrade. Nice move up here with earnings, big gap up. Medical supplies just breaking out on an absolute basis. That's nice. This is a stock relative to the medical supplies group that's about an 11.5 month relative high. So it looks pretty good here. It's actually been doing pretty well relative to the S&P, even though medical supplies has not been doing that well. But again, medical supplies, we might see the relative strength pick up now that we've got a breakout here. So I think that having one of the top stocks in the space, breaking out, nice volume, good earnings, I think CAH looks pretty nice. Let's see, another one. How about MSCI upgraded today? This is another specialty finance company like Moody's. Nice move up, relative strength near about a 7-8 month relative high. And again, you're in a strong group. So I agree with this upgrade. It could use a pullback, but that rising 20-day moving average, I think, would look pretty strong. Downgrades today. Teladoc got downgraded. This has been a really strong stock in the software space. One of the best. You can see the breakout here was, I believe that was earnings. Nice move here on the breakout. Continuing to tack on. Volume trends strong. Relative strength great. One of the best software stocks out there, and software has been killing it versus the S&P 500. Downgrade? I don't think so. I don't like this downgrade at all. In fact, downgrade anything close to that 20-day moving average to me is an opportunity. Sometimes these downgrades are opportunities, in my opinion. I like, if I've been watching a company I want to get in, I actually hope that it gets downgraded. That's one way to get the stock, get some of the price back, get in a little bit cheaper. All right, let's move on to the 3 you must see to wrap up the show. I am going to start first with Ingredion, INGR. This is a food products company, and you can see the volume exploded on yesterday's gap. Stock was up 8.23%, but this was a really nice breakout. You can see for the last year, we had gotten up March, April of last year around this 94 level, pulled all the way back in the low 70s, made our way back to 94, failed, came back down, and then finally made this breakout. And notice we gapped up above the resistance, which is what I like to see. The volume was strong, and you got a hollow candle. Normally, you gap up, you've got market makers on the short side. So you expect a stock to pull back from the open. When they go up on big volume, tells you that the demand is pretty strong there. And market makers really, for whatever reason, cannot get control of the action. And that is normally a pretty good sign. Now, it doesn't mean that it's just going to keep going up and up and up from here. I want to see how it performs. But what I would be looking at when I see something like this, I really don't look to the bottom of gap support. I don't look for this to fill. Instead, I look the top of gap. That would be my support level now. So you've got it. It's in the food products company. It's broken out now versus its peers to about a 9-month relative high. And the group itself has not been strong, and it's part of the defensive staples area. So if you want to get a stock that's breaking out that might be a little bit safer in terms of just being in a defensive area, then maybe this one would make sense for you. Looking out over the last 5 years, you can see on the weekly chart how it trended below the 20-week moving average during the downtrend for a year and a half. Now look what's happening. See how it's a completely different animal? If we were to get back down the road, I don't think it's going to be anytime soon, but maybe we consolidate around the mid-90s and that weekly 20-week moving average moves up. Anything close to the 20-week moving average is going to probably be a good buy heading forward. All right, next up is AIT. Pull this up on a relative chart. I liked, again, the breakout. This is not a huge volume stock. Liquidity might be an issue for some of you. It probably would be for me. But I just wanted to point it out because it had been going sideways here. It made this breakout. The volume picked up. That's what I like to see. And on a relative basis, this is a stock that's been performing pretty well. Now, I want to go back, and this is a long-term monthly chart. And you can see overall that it goes through periods of moving up, sideways consolidating, moving up, sideways consolidating. It seems like this is part of a move to get us back up to around the 80 level. And we're sitting at 69. So I wouldn't be surprised to see this lead to some additional strength. But again, going back to that daily chart, that's the first step. We moved up, consolidated for a while, and then we took back off again. And I think that is very bullish. One other thing I wanted to mention on this chart, if you go and you look at the PPO, see how when you move up and the PPO is strong, you expect the 20-day to hold. But then as it gets up here, you've got these negative divergences in play. We didn't have any kind of huge sell-off as a result of that. But simply by going sideways for a while, look at that PPO come right back to the center line. And then we turn higher and the PPO starts to rise again. Really important to see how that PPO can work sometimes. Doesn't always, negative divergence doesn't always mean a lot of selling. Next up, final stock, MCK, McKesson Corp. sideways consolidation for months. Look at the volume the last couple of days as it's broken above this consolidation range. I think we have a really nice looking chart here with McKesson. It had been going down for a while. It is now starting to turn higher. I think on a monthly chart, you can even see it better. See how since 2015 we were going down? Now it looks like we are moving back up. Monthly PPO just turning positive. I think MCK looks good. All right, that's it for today. Everybody have a great day, and I will be back tomorrow at Stock Charts TV at 9 o'clock for Trading Places Live. Hope to see you there. Happy trading, everybody.